All right. We just hit the live button, waiting for a few people to join us. Big episode today, and here we go. Sip of coffee before we get started. If you're drinking coffee or whatever, cheers. And here we go. Welcome to my live stream. I'm Mitch Goldberg. It's 4:30, and we're now getting into your post-market show. This is called Be the Boss of Your Money, where I really want to help you take control of your money. That's why we call it Be the Boss of Your Money. Today, markets continue to get pounded, stocks down across the board. The selling is indiscriminate, and there is definitely a sense of pure panic in the air. We're not at a panic, full all out selling flush, but I don't think we're that far. It's pretty ugly out there for a number of reasons. And what I said in the announcement of the live stream today, we're going to go over the real story, the real reason why this market's down so much. So we're going to roll a quick intro. We've got a good show. And, while you're watching, if you have any questions, please hit me up in the comments. I love hearing from you. Give a thumbs up, a heart, or celebrate, depending on which platform you're watching from. Let me know you're out there. Words of wisdom, words of encouragement in the comments are always appreciated as well. Here we go with the intro. Okay, welcome to my live stream. If you're just joining me, we're just getting started. We're talking about the drubbing that the stock market took today. Profits for the year are starting to disappear. Mega cap, widely owned stocks are tanking. There's panic in the air. The selling is indiscriminate. We need to know what's going on. What should you do next? What should you expect? Why are things going down? This is all so that you have the education and the tools that you need so you don't make a hasty decision that you're going to regret. We've got a couple of things to go over. So first and foremost, while you're watching this, if you have any questions, make sure you hit me up in the comments. Words of wisdom, words of encouragement in the comments are always appreciated. Hit it with a thumbs up, a heart, or something. Let me know you're out there. It gives me encouragement and lets me know that I'm on the right track, that I am bringing you value. Okay. I see Michael is out there, and really nice to see you. And here we go. Selling was indiscriminate beyond Apple. Yeah, that's right. I should just end the show right now. You are absolutely correct, except for Apple. Let's first and foremost show you the setup, what things were like today. All right, I'm going to make my screen a little bigger before you go on it. Okay, I'm going to share the screen. Let me get to screen 4. That's the monitor too. All right, so the Dow was down 652 points. Pretty tough day. I always say, 0.5% plus moves in the major averages. That's what gets my attention. 1% plus, I definitely want to slow down and see what's going on. Now, just want to say that 1% moves, 2% moves are not out of the ordinary, except for the last couple of months. But now they're back in vogue, I guess, right? We don't panic over these. These are normal. They happen. And you might not feel good about it, but if you know that this is what is to be expected every now and then, it'll help you get through the tough times. And once you get through a couple of tough times and you're an old geezer like me, and you're just a grizzled veteran with some gray hair, it gets easier, and you stop worrying about the stuff because you realize it's just part of the process. NASDAQ was down 1.5%. S&P was off 1.9%. Gold continues to sell off. No flight to safety trade in gold. Oil down over 4% back into the 60s. You know what happened? Yesterday's rally from last Friday's drubbing, when the market was down 905 points. We had a little bit of a rally yesterday. Not only did it give it all back, and then a whole lot more. So we're actually a good deal lower than where we were last Friday. All right. 10-year treasury down to the 1.4s. We were up to almost 1.7. Now we're in the 1.4s, and VIX explodes to the upside again at 27. Okay, you see that? I always tell you, over 20, market goes down. Under 20, the market goes up. That's the line in the sand. If the VIX hits 30 and actually closes above 30, then we're going to have a new line in the sand. Let's call it 25 for now. The Russell 2000, I want to show you this, was down 1.92%. Okay, down. That's the small caps sector. Okay, the Russell 2000 is the index that you should follow. It's the least followed of the major averages, but it's small cap stocks. Small cap stocks are more sensitive to the U.S. economy. They feel changes in the economy and changes, things. They suffer quicker and more deeply from things like lockdowns, people staying home, working from home. That hurts the smaller companies. They're more economically sensitive. So that's why of the major averages, the percentage-wise, the small cap Russell 2000 index was down the most. Okay, so let's keep moving along. Let's go check out crypto. Crypto actually didn't have a terrible day. Yeah, Bitcoin was off 1.62%, about in line with the major stock averages, but that's like a tame day for Bitcoin. Bitcoin, can move 2 or 3%, just like that, just for nothing. Okay, but a lot of the cryptos were also up today. Ethereum, cryptos tied to Ethereum, did pretty well. Litecoin was up, so not a bad day for crypto overall. Crypto is held up well. I know there's going to be somebody who says, "You see, I told you everything is crypto." You can tell an experienced investor from an inexperienced investor by the things that they say. And when somebody says, that's it, that is, crypto is better and the dollar is getting killed and too much money printing. If you're making a judgment just because crypto did a little better than stocks just for today, you're really showing that you're a neophyte. So stop talking and listen up. I want you to be better with your money. Take control of your money. Okay. So let's take a look at a couple of other things. I want to show you something that I posted today on LinkedIn. Well, by the way, while you're watching this, if we are not connected on LinkedIn, head over there now and connect with me. I post most of my content. Everything is posted on LinkedIn. And like today, I didn't post a video. I know what you're thinking. Oh, you didn't post a video today. Well, this is a video right now. No, but I usually post my little 30-second to 2-minute highlights from the live stream the day before. But this is just something I talked about yesterday in my live stream. I posted about it today. It says, we humans are great at making decisions at the worst possible times. In a time of crisis, our desire to avoid further loss and feel better in the moment is difficult to overcome. And we say, let me just get through this and I'll figure out what I need to do next when things calm down. It's a common and pre-programmed human trait. For investors, this usually means panic selling in a severely down stock market for the sugar high of feeling better now and having the intention to get back into it when things calm down. Well, I think this could be like one of my best posts ever. This is due to people's loss aversion being greater than their desire for gains. But no one ever made money by panicking. And I gave a list of how to avoid this fate, knowing what you own. In other words, don't just buy, a meme stock because it's going up. Let's buy GameStop. Let's buy AMC, or let's buy Doge. Okay, let's just run into these because they're going up. That does not mean you know what you're buying. You might know the name of a crypto or a stock. You might know the symbol for the stock. But that doesn't mean you actually know what you're buying. It doesn't mean you know how it fits in with your overall portfolio. Now, if you're just doing it because it's spec, you just want to throw a couple of bucks into it because maybe something great will happen and you could afford to gamble with that money, meaning that if it's a total bust, it won't hurt your overall ability to meet your financial goals, then go ahead. Go right ahead. Enjoy it. It's fun for a lot of you. But if that's not the case, then you really need to know what you own. So going back to that list, okay, by knowing what you own out, by reinforcing the reasons why you purchased your investments, okay, that's this one over here, all right, by reinforcing. What do I mean by that? Reinforcement of your why is, in my opinion, I'm giving you my own personal life experience here. Reinforcing your why is important. We've all heard of Simon Sinek, know your why. But what I'm saying to you is don't just know your why in a moment and then go on with your life forgetting about it. Sometimes we need to reinforce, we need to count our blessings once in a while. We need to step back in the worst of times and say, and ask ourselves, what am I grateful for? Let's find gratitude. That's what I mean. You have to, I'm getting a little philosophical on you today, but we have to reinforce what or we have to reinforce our why. Okay. Go through your investments, not just the time you buy them, but every now and then you have to look at your statement or go online and look at what you have and make sure it's still something you want. I'm in this stock because I think X should happen over X amount of years and the company should generate X in earnings and revenues. And the outcome should be a positive price appreciation. Do that do that often, do that regularly. That's what I mean by knowing your why. Okay, so let's go back into this. Understanding in advance, okay? Understanding in advance that there will always be a new crisis brewing somewhere in the world that you have no control over. You get what I'm saying? There's always going to be some crisis somewhere in the world that you weren't expecting. Okay. Understand that if they're not in your control, then don't let them control your decisions. We've had crises before, they've come to pass. Stocks have come to do well over time. Now, I'm making a generalization about an asset class. There can be no guarantee that they will always do well, but that's why you don't put all your eggs into one basket, right? So again, getting a little philosophical here, but by understanding in advance that there will be a crisis, you are better able to deal with the pressure or anxiety or fear, whatever emotions you're experiencing, but you'll also be better able to not let these emotions guide your decisions. Emotions got no brains. Okay. The next one is, let me go back to that. The next one, okay, is by controlling what you can and let time take care of the rest. You control things like dollar cost averaging. You control things like investment expenses, or you control things like putting in stop loss orders, trailing stop orders, buy limit orders below the market. There's all kinds of things that you could do to take control of, obviously, of what you could control. What I'm saying though is there are things you could do in advance of a decline in the market. Because if you're thinking like when the stuff is hitting the fan, that all of a sudden that's when you're going to make an informed, smart, well thought out decision. It doesn't happen that way. So control the things you can control, like dollar cost averaging, rebalancing your portfolio, raising the money that you'll need over the near term, putting that money in cash, not in stocks. That's what I mean by things that you can control. Okay. Now, by having a strategy that dictates your actions in times of crisis. What do I mean by that? We have a crisis, market tanks for whatever reason. Right now, it's Omicron, the new COVID variant, and what's going on with Chair Powell. What I want you to think of is in terms of, well, if the market goes down, what am I going to do? I had a conversation with somebody in the comments of this post, and I'll see if I could I'll see if I could find it. Here it is. Oh, I found it. I love this. But I want to thank LinkedIn for giving me great content. I was speaking with a friend of mine, chatting online with Michael Gordon, and he says indecision leads to bad decisions too. Great post, Mitchell. Thank you very much, buddy. And I wrote, thank you, Michael. Here's what I wrote. Doing nothing should be a conscious decision. I should have written conscientious decision. not a result of freezing under pressure. Agree with you 100%. Let me repeat that. Doing nothing should be a conscientious decision, not a result of freezing under pressure. If you, I don't want you to say, I'm not doing anything with my portfolio because you're afraid to open your statements or you're afraid to log into your account to see what things are going on online. Make it a conscientious decision. Doing nothing is a conscientious decision. That's a decision. Indecision is not a decision. So if you decide, I know what I have, I know what, I know the investments I have, I know what I own, I know why I own them, I know in what percentages I own them, and why I have why I have my investments allocated the way I do. And I've decided that I'm not going to change that. I'm going to give it time because volatility, like we're in now, is normal. I'm not going to do anything. I'm fine with it. That's a decision to do nothing. But if you're just going to ignore things because you're scared and nervous, that's indecision. That's not what we want. Okay, let's get back to that. All right. Scroll back up. Okay, by having a strategy that dictates your actions in times of crisis. That's what we were just talking about. But I'll say, for example, maybe you have a strategy where you say, if the market goes down a certain point, I'll buy more stocks. Or if you like a stock that was 100 and now it's 200, you feel like you missed it, you didn't buy it at 100, you might say, well, if it goes down to 175, I'll buy, 20 shares of it. But you have to put a buy limit order in ahead of time, because when it goes to 175, let's say on a bad day like today, you're probably never going to buy it because you'll say, well, now it's going lower. I'll wait until it goes lower. And if it goes back to 200, you'll say, I could have bought it 175. I'll wait till it goes back down again. And you wind up being in a position of endless procrastination. And that is that's the exact opposite of discipline. Okay, so let's keep going. We've got one more point to cover here. By realizing that the best thing an investor can do in times of crisis is often nothing, because you're sticking to your strategy. That goes hand in hand with the point we just made. And I wrote, an investment strategy is like a flow chart that takes into account that crises will happen and dictates in a predetermined way your next move. That is so important. A strategy, whether if it's in investing or anything else, really, business strategy, it predetermines your next move. So when you're in a crisis, in crisis management, and parts of your brain are shutting down and part of you is just, you're dealing with a million things, you're not really in a position to think in terms of what the best next move is. And you're not able to take a step back and clear your mind and think for a little while. I was talking with my friend Rob today. So shout out to my friend Rob Basso. We were talking about live streaming before. And and I was talking with my friend before, and Rob Basso, and what I said to him is this: on a down day like today, the best thing that I could do is literally go outside, get some fresh air, get a nice hot cup of coffee, and get out of the way for a little bit. It's the best thing I can do for my clients, because what you don't want to do is get caught up in the fear cycle that's going on and make bad decisions on behalf of yourself or your clients. And he said, Mitch, I'm sure your clients appreciate that. And I know they do. They tell me they do. And we don't have a great relationship with my clients. And they say they appreciate what I'm doing. Okay. The idea is that you don't want to just decide, I'm just going to sell this stock now. I'm going to raise cash for this. I'm going to raise cash for that. You're really panicking on emotion, but you're trying to fill in a logical reason to say, well, I'm panic selling. No, I'm not. It's not really panic selling. I'm doing something logical, like raising cash. No, you're not raising cash for a better day or better investments. You're doing something because you're nervous and you think you have to do something. It's not a good thing. Walk away from the computer. Go outside. Get some fresh air. Get a cup of coffee. Okay? Do some glue sniffing. No, I'm only kidding. I'm thinking the movie Airplane. Oh, that was so bad. Was that in poor taste? I'm sorry. I was just joking. I mean, get out of the office, away from the computer, away from your phone. Get a hot cup of coffee. Just relax because any decision you make for your clients is going to be the wrong decision in times like this. Okay, so I want to show you something that I've never shown you ever in the history of, of this live stream. Okay, let me just make my screen a little smaller. A little smaller. This is going to be interesting. I mean, I think it's going to be interesting. I don't know if you'll think it's interesting, but I want to show you my watch list. Just bear with me 1 second. I know I'm keeping you at bay for a second. All right, here we go. Okay, we're in good shape. I'm going to show you something here. Okay, I never show this to people. I never thought it was necessary to show this to you. Also, okay. By the way, Josh, I see you out there. Thank you for the heart. Right back at you. Okay, so I've never shown this on a live stream before, but I want to show you this now. This is my dashboard. This is basically all of the stocks that I follow. I mean, there are other stocks that I glance at, that I look at, but that doesn't mean they made it onto my dashboard, because if you fill up your dashboard with too many things, it becomes a distraction, and it's kind of like, the bear that the bear that it's kind of like the bear that chases two rabbits, but it catches nothing. You start going after too many things and focusing on too many things, your focus becomes diffuse, and that's exactly when you need a laser beam. Okay, so let's focus on this. Okay, this is what's down: industrials, energy, consumer staples. Look at all that red and a lot of percentage losses. 3% here, 3.4%. Okay, Cisco Foods down 4.3%. Why was Cisco down so much? Cisco Foods supplies restaurants, and if people are worried about Omicron and people are not going to go out as much, that hurts restaurants, which would hurt Cisco Foods. Okay. And then let's go to financials. Financials, Travelers, JP Morgan, Bank of America, all down across the board. Remember, I put in the thumbnail of this live stream. Okay. If you remember the thumbnail, I wrote stocks CRATER, the selling is indiscriminate. That's what I'm saying. We still haven't seen any green. It's indiscriminate. Okay. KeyBank was down. Goldman Sachs is down. MasterCard, Visa. I know MasterCard and Visa are really more like tech stocks, but I have them in both places, financials and technology. But okay, so let's keep going. Tech down across the board. Cisco, Twitter, Facebook, which is now called Meta. Apple is the only one in tech that I find that's up. It's up $5, up over 3%. But the rest of tech was down. PayPal was down. Robinhood down to 25, new low. Coinbase down to 315. Some of the healthcare stocks were up. Big whoop. Merck was up 2 cents. Pfizer was up $1.33. So that was a good day. But other than that, more red on the screen. United Healthcare down 1.72%. Just look at all the consumer discretionary stocks, the tech stocks on the right. In the middle is consumer discretion. Materials down. Alcoa was down 5%. U.S. Steel was down. Vulcan Materials was down. DocuSign getting crushed. Zoom down again. Oh my goodness. Amazon was down $54 a share. These are right in the middle is consumer discretion. Starbucks is down. Tesla was up 7%. I mean, I'm sorry. Tesla was up $7, but it was up 0.68%. But what you can see there is Apple and Tesla, they're like the only two stocks that are up. These are just ETFs, international ETFs. It's not really what I'm thinking of in terms of individual stocks. Interest rate products. Okay, the VIX is up, but that's not a good thing. We went over that before. The VIX tips are up, but bonds were generally up on the day, so I'm not surprised. But they're not stocks. Okay, and here's what I mean by indiscriminate. Okay, if you take a look at reopening stocks over here, okay, obviously reopening stocks got crushed. All right. So reopening stocks got crushed. But if you look at the Work from home, stay at home stocks. Let's go to my Corona list. Okay. Look, Teladoc, we're at the Clorox, Zoom, Activision, DoorDash, Campbell Soup, DocuSign, Domino's, Peloton. They were all down across the board. So what I'm saying is it's not like today was a day of rotation where we went from the reopening stocks to the back to the stay-at-home work from home stocks, and then we go back to the economy reopening scenario, and we get into the reopening rotation, the rotation of reopening stocks. It was just indiscriminate selling. It was just everything was dumped across the board. As bad as Friday was, last Friday down over 900 points, today was worse. At least last Friday, you could say it was a slow day. The stock market closed early at 1 o'clock on Friday, day after Thanksgiving. Nobody was around, light volume. But today is different. Today, everyone's around. Investors were making a conscientious decision to just blow out of stocks. And that to me is a lot worse. Today is a day that really people just didn't want to own stocks. And that's why today is so tough. At least Friday, you had the work from home, stay at home stocks like Zoom go up. Today, almost nothing worked. Out of all the stocks I showed you, hardly any of them were up. The heat map is a deep red. In fact, 92%, okay, 92%. This is so dramatic. I want to say it on a different camera. 92% of all trades on the New York Stock Exchange today were sells. 92% of the stocks are down on the New York Stock Exchange. That is a hard sell day. There, I did that for dramatic effect. Okay. Okay. Jay is out there. Hey, Jay, good to see you. Thank you for joining me. Okay. A couple more things to make sure. Okay. So here's what I want to tell you. Okay. We've got two things. I'm going to sit back and relax for a minute. Omicron is the excuse of the day. It's like, well, this is why the market went down. And I get that. We're worried about an economic shutdown. But what I want to point out to you is the real story today is not Omicron. The real story is Chairman Jerome Powell, chairman of the Federal Reserve. Okay. He has been like the Don Quixote of inflation fighters. He's tilting at windmills, thinking that they're dragons. Powell has been tilting at the inflation is transitory, okay, like Don Quixote, okay, with windmills. And today he acknowledged in his appearance before the Senate, his Senate hearing, well, inflation is around longer, and now we could taper faster. We've talked about this taper a million times, how the Fed buys bonds every month. When they start scaling back the amount of bonds the Fed buys every month to inject money into the economy, that's called taper, and they'll keep doing it until they get to buying zero bonds. They were going to finish up next July. He says we might finish up a few months earlier. When you're only talking about 9 months and you're going to finish up earlier by a few months, that's a lot. 2 or 3 months or 4 months out of 9 months is a lot. And the sooner the Fed gets to tapering, the sooner the Fed completes its taper, the sooner it will get to raising interest rates. But the real story here is this. The Federal Reserve has completely, officially changed its stance from fighting deflation, empowering the workforce to get to work. They are now fighting inflation. It's a completely different environment. The setup is completely different. It's freaking people out. It changes the dynamic. That's what's different. And that, my friends, is why the market went down so much and why so many stocks are down today. That's the real deal. It's not necessarily Omicron. A lot of people thought the Fed would actually become dovish, that they would say, we're not going to accelerate the taper. Maybe we'll even lengthen the time of the taper because of Omicron. But nope. And that was partially the expectation yesterday. Today, he's like, no, I'm just going to probably slam the brakes on Fed policy, even though we all started to think I would really slam on the gas pedal yesterday. So it's a real shocker to people and totally unexpected now. Yesterday, we heard from the CEO of Moderna. He said, we expect good things. We think the vaccines will continue to work. Maybe a little bit less effective, but should continue to work. We'll have a new vaccine in 3 months, and everything will be fine. Well, he was less optimistic on his interview today in Bloomberg, saying that the new COVID strain, Omicron, might invalidate vaccines or might make them much less effective. News on the tape says the FDA advisory panel narrowly endorses Merck's COVID treatment pill despite reduced efficacy. Okay. The Pfizer pill should still work very well because it's not based on the protein spikes that the mRNA vaccines are based on. In any event, and yesterday people were soothed by a South African doctor saying patients he's treating are really seeing just mild symptoms of COVID. And now they're saying, wait a minute, we've got to see how this works. South Africa has a younger population, so they're more, younger people are more able to get through a COVID infection better than older people. It's not the case in a lot of other places like the United States, Europe, Japan, and China. And okay, so that's something that is being talked about today. So this is where we are, folks. It's it's a lot. Oh, by the way, Jay's out there. It's healthy to correct. Trees don't grow to the sky. That's correct. After today, we might have to start growing some new trees, start planting some seeds. We're going to have to wait till the spring for that, though. So it could be a long winter. Anyway, that is the story today, and that's really what happened. It's simply that the Fed has gone from fighting deflation and empowering the workforce to fighting inflation and gearing up for an inflationary environment. They're really acknowledging that they are now fighting a new battle, and that's just it's just a huge change in direction for the market. All right, I thank you all for watching. I know we went over a little bit by a couple minutes. I thank you, and I'll be back tomorrow with more. If you have any questions that you think of after the live stream, definitely hit me up. And if you don't know, you can catch me on all these social media platforms: Instagram, YouTube, LinkedIn, and Facebook. And until then, stay well.